Welcome back. So, in the last lecture I was talking about trading strategies comprising of one or more financial instruments, particularly derivatives. I discussed the long call and the long put strategies and the short call and short put strategies. The upside in the case of the long call is unlimited, and therefore, the investor perception when he goes for a long call strategy is that the stock prospects are extremely bullish as on the date of maturity of the option. Recall that we are talking about European options at the moment. Then the short call, which is the inverse of the long call, would be optimal if the perception is inverse to that of a long call holder, that is the person who indulges in this strategy, indulges in a short call strategy, feels that the stock price is not going to go up, as a result of which the option would not be exercised, and consequently he would pocket the premium by writing a call on the stock. Similarly, in the case of put options, the long put option strategy would be optimal if the perception is bearish as far as the investor is concerned. Lower the stock price, in fact, on the date of maturity of the option, the higher is the profit from a long put strategy, and consequently an investor who is bearish on the prospects of a particular stock would indulge in the long put strategy. The short put strategy is the inverse of the long put strategy, and the trader or the party undertaking the strategy would be anticipating that the stock price would be bullish, and as a result of it the long put holder will not exercise the option and he could get the premium. Then I talked about the covered call strategy, which comprises of what? Which comprises of a call option written on the underlying asset, that is a short position in the call option together with a long position in the underlying asset. A long position in the underlying asset plus a short position in a call that is written on the same underlying asset. The behavior of the strategy is pretty much similar to that of a short put strategy. And then the protective put strategy involves a long position in the underlying asset and a long position in the in a put option written on the same underlying asset. By virtue of having a long position in the put option on the same underlying asset, we are buying in some sense an insurance on a price fall in the underlying asset. If the value of the underlying asset falls below the exercise price of the put option that we have a long position in, then I could exercise with the long put option and thereby reduce or minimize the loss that could emanated from the fall in price of the underlying asset. Then we moved over to straddles and strangles. In the case of straddles, we have a long position in a put call option and a long position in a put option, both on the same underlying, same maturity, same exercise price, and of course, both the options are European. The payoff from the straddle is a V-shaped figure, as a result of which the party who is long in the straddle makes a profit when the underlying assets price ends up a distant away, significant distant away from the exercise price of the two options, either to the left or to the right. In other words, the price is much below the exercise price or much above the exercise price. That is and if the price ends up pretty much close to the exercise price, the party makes a loss equal to the combination of the or the aggregate of the cost of putting up or setting up the strategy, that is the cost of the long call and the cost of the long put. So, that is as far as straddle is concerned, and straddles would obviously be optimal when there is likely to be a significant corporate event in the life of the underlying company, as a result of which the outcome of that event could significantly influence the underlying price or the stock price. If the outcome turns out to be positive, possibly the stock price could rise significantly, and if the outcome turns out to be negative, the stock price could fall significantly. For example, the settlement of a claim, of a massive claim, or a settlement of a litigation, a decision on a litigation, a public offering or a merger acquisition takeover proposal, or or some government announcements in the budget. So, these are examples which could help you if you are planning to take up a straddle strategy, or these are the circumstances in which a straddle strategy could turn out to be optimal. Then we talked about strangles. In the case of strangles, the strategies are pretty much similar to the case of a straddle, except for the fact that the exercise price of the long call and the long put are different. We have two scenarios here. We have the scenario in which the exercise price of the call option is greater than the exercise price of the put option. In this case, the diagram or the profit diagram is shown in the right hand panel of the slide. So, we buy a call A with the exercise price of K C, maturity T and cost C. We buy a put B of exercise price K P, maturity T and cost P. All both of them are European, both have the same underlying, both have the same maturity, but have different exercise prices. As I mentioned, we have two scenarios, one K C greater than K P, the other K C less than K P. I had discussed the scenario where K C is greater than K P. In this case, we can split up the spectrum of stock prices into three segments. 0 is less than ST is less than KP, KP is less than ST is less than KC, and then KC is less than ST. Now, in the first case, when 0 is less than ST is less than KP, then what happens? The put option will be exercised and the call option will lapse. In the case when Kp is less than St is less than Kc, the both of the options will lapse, neither the call nor the put will be exercised, and if Kp is less than Kc is less than St, the call will be exercised, the put will not be exercised. This is the tabular form of the payoffs from the strangle strategy, where Kc is greater than Kp, and these are the salient features. The profit is unbounded, as you also saw from the diagram, the profit is unbounded. The loss is equal to the cost of creating the strategy, that is the aggregate of the put option premium and the call option premium, and the break even points are equal to Kp minus P plus C and Kc minus P, Kc plus P plus C. Then we look at the second strangle, where Kc is less than Kp. We again divide the spectrum of stock prices into three segments. 0 less than Kc, in which case what will happen? The call will not be exercised, but the put will be exercised. Kc is less than St is less than Kp. In this case, call as well as put both will be exercised, and Kc less than Kp less than St. In this case, the put will not be exercised, the call will be exercised. So, let me quickly repeat: St less than Kc less than Kp, put is exercised, call will not be exercised. Kc less than St less than Kp, both of the options will be exercised, and Kc less than Kp less than St, then only the call will be exercised. And here are the salient features of the profit function of a strangle in the case when Kc is less than Kp. If St is less than Kc, then this 1 will hold. This is quite straightforward. If St is greater than Kc, but St is less than Kp, then what happens? Both the options are exercised, and as a result of which we get the profit function given by equation number 2. And of course, if Kp is less than St, obviously Kc would also be less than St, because Kc is less than Kp, then only the call option is exercised, and we have this as the profit function, in number 3 as the profit function. And as you can see here, the maximum profit of the strangle is unlimited, it is unbounded. The minimum profit is, in this case, it is not the cost of setting up of the strategy, it is Kp minus Kc minus P plus C, and the break even points are at Kp minus P plus C and Kc plus P plus C. Now, let us look at the minimum profit of the strangle that we saw in the previous slide was given as Kp minus Kc minus P plus C, and now let us look at what is going to be the sign of this expression, sign of equation number 1, whether it is greater than 0 or whether it is less than 0. For this purpose, we write the put call parity for the call and the put which comprise the strangle. We have this as equation number 1 for the long call that comprises the strangle. What is PC? PC is the put corresponding to this call option having the same exercise price as the call option, that is KC. Similarly, for the long put option, we have this equation number 2 as the put call parity relationship. What is CP? CP is the call option with the same exercise price as the long put that constitutes the strangle. So, using the equation number 1 and 2 and simplifying, what we find is equation number 3, and equation number 3 shows that Kp minus Kc e to the power minus Rt minus P plus C is less than 0. If we ignore the time value of money, if we take R is equal to 0, that is, then we find that Kp minus Kc minus P plus C would be less than 0. This is an important part of the strangle configuration when Kp is or Kc is less than Kp, Kp is greater than Kc. Now, we talk about strips and straps. A strip consists of a long position in one call and two puts with the same strike price and expiration date. So, in some sense this is similar to a straddle. In straddle, what do we have? We have a long call and a long put with identical exercise prices, identical maturities, and the same underlying asset. Here, instead of one call and one put, we have one call and two puts, long position in one call and long position in two puts on the same underlying, same maturity, same exercise price, and of course, the same type, that is European. We are talking about European options at the moment. In strap is also similar. In the case of a strap, what do we have? We have a long position in two calls and long position in one put. So, in the case of a strip, we have a long position in one call and two puts. In the case of a strap, we have a long position in two calls and one puts. That is the difference between a strip and a strap. In a strip, the investor is betting that there will be a big stock price move, just like in the case of a straddle, and considers a decrease in the stock price to be more likely than an increase. Why? Because please note, he is having a long position in two puts, and puts tend to reward the investor, reward the trader when the stock price tends to be down. Now, because you are long in two puts, you will make a profit of 2 units for each unit change or each unit decline in the exercise price in the stock price below the exercise price. So, that is the reason that in the case of a strip, the investor is betting on a significant change in the stock price first of all, and number 2, the possibility of the price declining significantly more in the perception of the investor compared to the possibility of the stock price increasing. Although, if the stock price increases significantly, the long call would come into play, and again he would make a profit, but the profit that he would make if the price declines would be double the profit that he would make if the price increases, because he is long in two puts compared to a long position in one call. This is the diagram. You can see this angle is, and this angle here is tan inverse 2. That means what? That means if you are in this region, that is to the left of K, that is the stock price is below the exercise price, then for every unit decline in the stock price, you will make a profit of 2 units on the basis of the 2 long puts that you have. On the other hand, if the stock price increases beyond K, and then your incremental profit rather is 1 unit for each unit increase in the stock price. And the right hand panel shows you the payoff or the profit diagram in the context of a strap. The left hand side gives you the strip profit diagram, and these are the profit functions of the strip, and strap can be worked out similarly. You can see here, if ST is less than K, then this 2, if you simplify this, it turns out to be 2k minus 2 st, 2k minus 2 st. The fact that the coefficient of st is 2 means that if you differentiate with respect to st, you find you get a value of 2. That means, for every unit change in decline in the stock price, the profit increases by 2 units, because you have got 2 puts. You see, it is elementary in fact. And if you because you have long one call, the profit increases 1 unit for every incremental increase in the stock price. The coefficient of st is 1. Maximum profit is unbounded, as you saw in the diagram also. The minimum profit or the maximum loss, you may say, is equal to the cost of setting up of the strategy, that is 2 p plus c. 2 p means the cost of setting up of 2 puts, long position in 2 puts, and the cost of c, that is the long position in the call option. The break even points are given as shown in the slide. Now, we talk about spread strategies. Now, the general definition of a spread strategy is that it consists of a combination of a long position and a short position in options of the same type. For example, it could be a long position in a call option and a long position and a short position in the call option, or it could be a long position in a put option and a short position in the put option. But now, there are different types of spreads. Number 1, we have vertical spreads. Number 2, we have horizontal spreads, and number 3, we have diagonal spreads. What are vertical spreads? Vertical spreads are those spreads which comprise of options of the same type, long position and short position in option of the same type, but with different exercise prices, same underlying, but same maturity as well. So, let me repeat: vertical spreads comprise of long position in an option of a given type, short position in an option of the same type with the same underlying asset, of course, same European or American, as the case may be. Then number 3, they would have the same underlying, as I mentioned, they would have the same maturity as well, but they would have different exercise prices. So, vertical spread means different exercise prices, otherwise same, and a long position and a short position, everything same except for the exercise prices would be different. In the case of a horizontal spread, what happens? Everything is same except for the fact that the maturities are different. So, in the case of horizontal spread, we have a long position in a given option, a short position in the same option, same underlying, same exercise price, but different maturities. So, that is a horizontal spread. And what is a diagonal spread? It is quite obvious, it would comprise of different maturities as well as different exercise prices. So, quickly recap: vertical spread, same maturity, different exercise prices, same underlying; horizontal spread, same underlying, of course, same exercise price, different maturities; and diagonal spreads, different maturities, different exercise prices, and same type, of course, long and short position. So, what are the common vertical spreads? Bullish vertical spread with call options, bearish vertical spread with call options, bullish vertical spread with put options, bearish vertical spreads with put options, butterfly spreads with calls, butterfly spread with puts, and then box spread. Let us quickly move on. First case, bullish vertical spread using call option, bullish vertical spread using call option. What is this? This is a long position in a call A and a short position in a call B. Both are European and both are call options. One is long, that is A, the other is short, that is B. The exercise price of A is lower, the exercise price of B is higher. Therefore, what will happen? Because the premium is inversely related to the exercise price in the case of call options, the premium of the call option A will be higher than the premium of call option B. That means what? That means that it will entail a cash outflow on the part of the investor to set up the strategy, because he is long in call A and the premium of call A is higher. In other words, he is buying call A and the premium on call A is higher. Therefore, he has to pay a higher amount of money compared to the money that he would receive by taking a short position in call B, which has a higher exercise price. So, this is the diagram. The right hand panel shows you the diagram, and you can again split up the stock price spectrum into 3 parts. 0 less than S t is less than K A, K A less than S t less than K B, and then K B less than S t. Now, when 0 is less than S t is less than K A, what will happen? Obviously, it has to be less than K B as well. Then what happens? Neither call A nor call B will be exercised, and the payoff to the investor would be negative. That is the expense or the difference of premium between the price that he has paid for buying option A and selling option B. So, the cash outflow in that case would be, which would be a negative figure. Now, if S t is less than K A less than K B, what happens? That we have already discussed. As S t is less than K A less than K B, we have discussed. Neither option is exercised. So, it is only the difference of premium that materializes. If K A is less than S t is less than K B, then option A will be exercised, because S t is greater than K A. So, option A will be exercised, and you are long in option A, please note. So, this region starts in that case, and K B will not be exercised, because your stock price is below K B, and if the stock price is below the exercise price, call options do not get exercised. Why? Because they are right to buy. Then when K B is less than S t, both the options will be exercised. Your long position in option A will be exercised, and the short position in option B will be exercised by the person whosoever is long in option B. As a result of which, the slopes will cancel each other, and we have this horizontal line here. So, that is the explanation of this figure. This is the figure where this is the portion where none of the options is exercised. This is the portion where A is exercised, and this is the portion where A plus B are both exercised. So, this is, I have already explained this just now. So, we move on. This is the tabular representation of the payoffs. You can see here, if S t is less than K A, the payoff is 0, and therefore, the cost is equal, the cash flow is equal to C B, that is what you receive, minus C A, but which is negative, because C B is less than C A. The exercise price B of call B is higher, the exercise price of call A is lower, and therefore, the premium are inverse of this. And if a K A is less than S t is less than K B, then option A is exercised, it gives you this payoff. Option B is not exercised, so it gives you this payoff 0, and the net payoff is equal to S t minus K A, as you saw in the diagram as well. And in the case when S t is greater than K B and obviously greater than K A as well, both the options are exercised, and therefore, you can see here S t and S t cancel out, and the net payoff is equal to K B minus K A, which is independent of S t, and that is the reason that we have this straight line here. This is the straight line. This represents the region where both the options are exercised, and the net payoff is independent of the stock price S t, because this is and so this line is parallel to the x axis, that is the S t axis. This is the analytical representation and profit function representation of the vertical spread with call options. You can see here in this particular set of equations, if S t is less than K A less than K B, the net payoff is C B minus C A, which is negative. If S t is greater than K A but less than K B, then the payoff is this, and this is directly related to S t. So, with 1 unit, so the slope of this line that we have here, this line is 45 degrees, because the coefficient of S t is 1, and then the final part, when S t is greater than both K A and K B, both the options are exercised, and because we are long in one and short in the other, the S t cancels out, and we have a payoff which is independent of the stock price. Let us look at the sign of this KB minus KA plus CB minus CA, that is this expression, this part. I have shown that it is, I have written here that it is greater than 0. Let us establish this fact. This is can be easily established by writing down the put call parity relationship for the two options and then subtracting them. What we have is KB e to the power minus RT plus CB. The S naught factor in the put call parity equations will cancel out, and what we will be left with is KB e to the power RT minus CB minus KA minus e to the power RT minus CA is equal to PB minus PA. PB is the put option corresponding to the exercise price KB, and PA is the put option corresponding to the exercise price KA. Now, because KA is less than KB, it must necessarily be that PA is less than PB, because remember, put option is a right to sell, and that means what? PA is less than PB means this is greater than 0, and this means that this is greater than 0. Of course, we are ignoring the time value of money for the moment, because in general in the case of options it is insignificant, at least for short dated options. So, we have KB minus KA plus CB minus CA is greater than 0 on the basis of ignoring time value on option premia. Right. So, now we come to a very interesting issue. Why bullish spread as against long call? Let me first draw the diagram for the long call. This is how the long call diagram is seen. Now, the interesting part is, why would somebody prefer a bullish spread rather than a long call? Why would you prefer a bullish spread rather than long call? You see, what is happening is, if you compare these two diagrams, what is happening is that this part is missing in this particular one. In other words, the slope line is replaced by a horizontal line. In other words, what we can see here is, if we go for a bullish spread, we are losing out on potential profit if the stock at maturity finishes up greater than KB. Had we had a long call, then this line would have been in this form. Therefore, what we are seeing here, if ST ends up greater than KB, we do not get any profit. Although, if we had taken a long call strategy, obviously, we would have made a profit of 1 unit per unit increase in the stock price. So, the question is, why would somebody sacrifice this profit, this region of profit, and go for the straight line? That is a very interesting question. The answer is quite simple. The answer is that the person who is taking up this bullish call spread, who is indulging in this strategy, has the perception that the stock price is not going to increase beyond KB. In other words, he is bullish about the stock price, he is happy about the stock price going up, but at the same time he is anticipating that the growth in the stock price will truncate, will stop at KB. It will not go further. Therefore, what he does is, he writes an option, call option with a stock, with an exercise price greater than KB, because his anticipation, if it turns out to be true, then the stock price will turn out to, if the stock price turns out to be higher than KB, then only that particular short position comes into play, and he has to incur the liability of honoring his commitment. But his perception is that that would not occur, that would not arise. The stock price at maturity would be below KB, that is his anticipation, that is his expectation. And so, on the basis of his anticipation, his expectation, he says, okay, I will write a call option and I will pocket the premium, because that option is not likely to be accessed as per my perception, and I will use that premium to set off this a certain amount of cost in incurring that is incurred for taking the long position in call option A. So, let me quickly repeat this. The perception of the investor who indulges in a spread strategy is that the stock price is going to lie within a range. It is not going to, in this case, in this particular case, it is not going to go beyond KB, and because it is not going to go beyond KB, he is happy to write a call option. If somebody is there to buy it, he is happy to write the call option, because he feels that that will not be accessed, and he can pocket the premium and use that premium to reduce the cost on taking of his long call strategy long in option A. So, that is the rationale behind a spread strategy. It is all a question of perceptions. If you have a strong perception that the stock price is going to go up and significantly up, you would rather use a long call strategy than a spread strategy. If you feel that the upward movement of the price is going to truncate at certain level, then you can write a call above that level of truncation, use the premium to set off a part of the profit, a part of the cost that you are going to incur for taking a long call position. I will continue after the break. Thank you.